Let's kick it off with our top story this morning. That's the European Central Bank cutting interest rates by a quarter of a basis point, or by a quarter of a point here, 25 basis points in a nearly unanimous decision. President Christine Lagarde warning that inflation remains high and the central bank will continue to be data dependent moving forward. We want to bring in Jean-Claude Trichet, former president of the ECB. Jean-Claude, it's great to talk to you here. So just first, give me your quick reaction to the decision, and then also more specifically some of the commentary that we were getting from President Christine Lagarde just moments ago, just about the fact that she still sees inflation being a bit too high and seems relatively concerned about some of those trends.
Yes, indeed. Thank you very much for your invitation. Let me say that the decision which was taken was very much anticipated. Clearly, the Governing Council of the ECB and the chair of the ECB had very, very clearly mentioned that it was very likely that they would start decreasing rates in this occasion, as well as they were very well communicating that the previous meeting was not to decrease rates. I think they are quite good in telling the market what is likely to happen. That being said, of course, there has been both bad news and some good news in the European area. The bad news is that headline inflation as well as core inflation picked up by 0.2%. So 2.6% instead of 2.4 for headline, 2.9 instead of 2.7 for core is bad news, and it was not really expected. And it accompanies also the fact that the negotiated wages picked up in the first quarter of this year. It also goes with the services inflation to be quite on the upside with 4.1% in May instead of 3.7 in April. So we have there clearly indications that the path toward disinflation is a little bit bumpy, more bumpy than most, I would say, observers had anticipated. I mentioned also some good news. I have to go there also because unemployment decreased to 6.4% in April, which is the lowest unemployment on record since the setting up of the euro, which is quite substantial. And clearly, the last PMI are indicating that the economic recovery is going with some more momentum.
Right.
So all this makes sense, by the way. If you have a better real economy, of course, disinflation is a little bit more difficult.
So I understand what you're saying here in terms of the unemployment picture looking better, but the inflation picture still being tough for them. From your perspective, if you were still in your role as former ECB president, just how hawkish would you want to remain in tone and tenor to be able to still fight the inflation that even President Lagarde mentioned is still incredibly high?
Well, what has been said very clearly by the Governing Council and by Christine Lagarde is that their future decisions would be data dependent and decided meeting by meeting. And I think that it is very reasonable to do that. In my time, I was very attached also to not ex ante pre-commitment in normal times. That doesn't mean that you cannot give the market some indications in order not to surprise permanently the market. But again, I think they are right to mention the fact that they do not want to be pre-committed to a particular path for the decrease of the interest rates. And frankly speaking, it seems to me very wise because now they have succeeded extremely well from a peak at 10% to go down a lot. And the expectations, the anchoring of expectations is quite good. So they have to continue to be cautious. I would not say that they would continue to be hawkish. No, it's not the case. But continue to be as cautious as is necessary in order to reach the goal. And the goal is 2% in the medium term.
Jean-Claude, when we talk about the fact that ECB is stressing the fact that it's important to remain data dependent, it sounds like going forward, Lagarde was asked a number of questions just about wages. And I guess my question to you is how difficult is that to analyze and the ultimate impact that it's having here, more broadly speaking, on the economy, specifically inflation?
Well, first of all, of course, you have to remember that the euro area is made of 20 different economies. It's not as simple as in the US, of course. So you have any time to be sure that you are capturing what is the reality in the euro area, which is, again, a little bit more complicated than in the US first. Second, you have a lot of economies which are deciding on their wages and salary increases on the basis of a multi-year basis. And of course, that creates some kind of hysteresis, both, I would say, with interest rates being high and inflation being high when you are still running with the previous negotiations for wages and salaries. And then, of course, it amputates the standard of living and the purchasing power of the, I would say, wages and salaries. And at other moment, you have a catching up exercise. So you go in the past, you augment wages and salaries to take account of these losses of purchasing power. And then, of course, you have a much lower inflation, so you're giving a lot of purchasing power. So that is the moment where the ECB has to be cautious, as I said, prudent and cautious, and look exactly at what happens in order not to lose the good path they have towards their goal. And their goal, again, is 2% over the medium term.
Jean-Claude, let's end by bringing this back to the Federal Reserve here in the United States. Is the ECB teaching the Fed what a soft landing could look like here?
I think that the US did also quite a good work, obviously. And when I look at we don't have yet the May figures for the US, but in comparing May figures in Europe and April figure in the US, I don't have such a big difference. Headline 3.4 versus 2.6, so 0.8% of difference, and core 2.9 in Europe, 3.6 in the US, 0.7% of difference. So we came both from a very high level, 11 interest rates increases in the US, 10 increases in Europe by the ECB, have done quite a job, obviously. And I explained the difference between the US and Europe in terms of, I would say, disinflation by the fact that obviously, due for a good part, I have to say, to fiscal expansion, real growth in the US was largely superior to real growth in Europe during the last period of time. So, of course, it complicates the life of the United States. But it seems to me, seen from a distance, you clearly have two central banks with the same goal, 2% in the medium term, which is remarkable, by the way. And I would stress the fact that we are in a totally different world today than we were at the moment of the first and the second oil shock years ago, with, I would say, Paul Volcker embarking on getting back to price stability. Now we have the same definition of price stability on both sides of the Atlantic. And again, it seems to me that we are two ships that are going in the same harbor. The same harbor is percent in the medium term, but of course the weather is not the same in Europe and in the US. So the decisions are not exactly the same, but the goal is the same.
All right, fair enough, Jean-Claude. Always really appreciate your insights. Thank you so much for making time for Yahoo Finance. That was Jean-Claude Trichet. He is the former ECB president joining us on their rate cut from this morning.